I want you to forget almost everything you were taught about money growing up, because if you were following the traditional financial playbook written 20 or 30 years ago, you aren't building security, you are walking straight into a hidden tax trap. The economic rules shifted, the IRS code changed, and the strategies that built wealth for previous generations are actively holding you back today. Today, we are dismantling 7 traditional money rules that you need to completely ignore. And trust me, rule number 7 is so counterintuitive that it goes against everything standard gurus preach. But it is the single most important shift you will make for your future. Let's craft your wealth together. Welcome back to Teddy's wealthCraft. We bring you zero-hype, professional financial strategies specifically tailored for the unique reality of building wealth in today's economy. Let's jump straight into the first rule you need to throw in the trash. Rule 1. Always max out your pre-tax 401k first. For decades, financial advisors screamed this from the rooftops. Dump every spare dollar into your traditional 401k to lower your taxable income today. That was great advice when tax rates were higher and life was simpler. But if you put 100% of your retirement savings into a pre-tax account, you are creating a massive tax monoculture. Every single dollar you pull out in retirement will be taxed as ordinary income. Even worse, when you hit your 70s, the IRS forces you to take required minimum distributions, RMDs, whether you need the money or not. Those forced withdrawals can spike your tax bracket, trigger higher Medicare premiums, and shrink your Social Security checks. Instead of blindly dumping everything into pre-tax, prioritize tax diversity. Leverage Roth accounts and health savings accounts to build tax-free buckets for your future. Rule 2. Keep 6 months of cash sitting in a standard savings account. We've all heard it. Save 6 months of living expenses in cash for emergencies. While having a safety net is non-negotiable, keeping tens of thousands of dollars sitting in a traditional brick-and-mortar savings account earning 0.01% interest isn't safety, it's guaranteed loss. Inflation silently eats away your purchasing power every single year. Your emergency fund shouldn't be rotting, it should be working. Park that cash in high-yield savings accounts, short-term treasury bills, or money market funds. Keep your liquidity, but demand a yield on every single dollar you own. Rule 3. Paying off your mortgage early is always the best investment. There is an emotional comfort to owning your home free and clear. But emotionally feeling good and mathematically building wealth are two very different things. If you locked in a low fixed mortgage rate years ago, rushing to pour extra cash into your house ties up your liquid capital in an illiquid asset. You can't buy groceries with home equity without taking out a loan. If your capital can earn a higher net return invested in low-cost index funds or high-yielding assets than the interest rate on your debt, paying off that low-interest mortgage early is costing you hundreds of thousands of dollars in lost compounding power over time. Rule 4. You need a huge amount of capital to start building passive income. The standard myth says you need $500,000 sitting in dividend stocks or real estate to make meaningful passive cash flow. That was true before the digital revolution. Today, your most valuable wealth-building asset isn't capital, it's wisdom. You are sitting on decades of real-world experience. Whether you mastered project management, logistics, specialized software, or home organization, someone 10 years behind you is desperate to learn that framework. With modern AI tools, you can package your lifetime of experience into digital products, guides, or masterclasses with zero startup capital. You build the asset once, and it generates high-margin passive income for years. Rule 5. Cut out the $5 lattes to become rich. Nothing frustrates me more than financial gurus telling hardworking adults that micro-frugality is the key to wealth. Frugality has a ceiling. You can only cut your expenses down to zero, but income has no ceiling. Obsessing over $5 lattes or $10 streaming subscriptions drains your mental energy away from high-leverage activities. Stop spending 90% of your time trying to save pennies on minor expenses. Shift 90% of your focus toward increasing your income, optimizing your tax efficiency, and building automated investment streams. Focus on the macro levers, not the lattes.
Rule 6. All debt is evil and must be avoided. We were taught that all debt is a moral failing. But the wealthiest individuals and corporations on Earth don't avoid debt, they harness it. You must distinguish between consumer debt and strategic leverage. High-interest credit card debt that buys depreciating items will destroy your wealth. However, fixed-rate, low-interest debt used to acquire income-producing assets or expand a business is a tool for exponential growth. Wealthy investors use leverage to acquire assets, offset inflation, and maximize tax deductions legally. Learn to master debt rather than fearing it.
Now, before we hit rule number 7, the one that shocks most investors and flips standard advice on its head, I want to ask you a quick question. Which of these rules have you been blindly following up until today? Drop a comment right now and let me know. I read and reply to every single one. And if you're finding value in this, hit that subscribe button to join our community.
Rule 7. Diversify into dozens of different investments to be safe. You've been told never put all your eggs in one basket. Spread your money across dozens of stocks, mutual funds, international equities, and obscure sectors to protect yourself. The shocking reality? Over-diversification, often called diversification, doesn't protect your wealth. It dilutes your returns into total mediocrity. When you buy dozens of random funds, you are simply paying multiple layer fees to track the average market, or worse, underperform it. You don't need a chaotic portfolio of 40 different funds to build generational wealth.
For the vast majority of investors, an ultra-simple, low-cost core strategy, focusing on broad market index funds, tax-sheltered accounts like an HSA, and 1 or 2 cash-flowing assets you actually understand, will outperform a hyper-complicated, over-diversified portfolio every single time. Complexity is the enemy of execution. The economic landscape has changed. Playing by old rules in a new economy is the fastest way to get left behind. Automate your tax-efficient accounts, focus on high-leverage income generation, and package your unique experience to build true financial independence. Keep crafting your wealth, stay focused, and I will see you in the very next video.